Welcome to this webinar, Investing with Impact in EMDE Public Markets, the Importance of Additionality, sponsored by MOBILIST and the Impact Investing Institute. I'm Jamie Broderick, Deputy Chair of the Institute. If you don't know us, we're a UK-based nonprofit dedicated to promoting the growth of impact investing in the UK and globally. We work across a broad spectrum of asset owners, asset managers, policymakers, civil society, and communities to promote and support impact investing with the objective of contributing to a fairer, more inclusive, and sustainable economy. In this afternoon's conversation, we're going to consider routes to impact through public markets with a particular focus on impact in emerging market and developing economies. Now, surveys of asset allocators and asset managers show that impact investing through public debt and equity instruments has grown significantly over the past 5 years. This trend has been enabled by better awareness and more sophisticated approaches to impact management in public markets, which helpfully in turn have been reflected in guidance from regulators. However, in the emerging markets and developing economies, impact investing remains overwhelmingly in the private markets. Some of those using ESG screens in listed markets seem to be avoiding developing countries, the markets that need their capital the most, because of data deficiencies and imprecise understanding of risk or backward-looking metrics. So today we're going to hear from some pioneering asset managers and development finance actors that have been trying to scale impactful investments in listed debt and equity instruments, and we'll hear about their approaches to maximizing and monitoring impact in developing countries. We'll also ask the question, how are developing countries different, and are there unrecognized opportunities for outsized impact when investing in these markets through listed instruments? This is the argument put forward by a piece of research that is about to be published that was funded under MOBILIST, a program of the UK's Foreign, Commonwealth and Development Office, known as FCDO among friends, which focuses on mobilizing capital from institutional investors into emerging market and developing economies through listed instruments. So we'll hear the arguments for public markets and the challenges that practitioners face, and then we'll look forward to your questions and comments on this whole set of really important issues. So we're pleased to have with us today a combination of speakers representing public sector donors, impact asset managers, and development finance institutions. We'll start with Chris Eleftheriades from the MOBILIST program, who will share some headlines from the research I mentioned, making the case that there are opportunities for systemic impact when investing in developing country listed markets. Then we'll hear the opportunities and challenges from a practitioner's perspective, with contributions from the Asian Development Bank, British International Investment, Confluence Investors, and BlueOrchard. You can see them on your screen, but I'll introduce them a little bit later. And we want this to be a conversation, so please do share your questions as we go, and we'll get through as many as possible later on in the session. A word on housekeeping. Please share questions and comments using the Q&A function. Please share your name and affiliation when you submit a question or comment, although to be honest, I won't turn away a really good question from anyone named anonymous. And just to say that the session will be recorded and made available online after the event. So let's go to Chris from MOBILIST to get the sneak preview from the research. Chris, over to you.
Perfect. Thank you so much, Jamie, and I hope you and everyone can hear me well. So as Jamie said, I'm Chris Eleftheriades. I'm the research lead on the MOBILIST programme. MOBILIST is a flagship initiative of the UK government that seeks to mobilise capital into emerging market and developing economies through the public markets. And it's that focus on listed instruments and public markets that we think is an important differentiator of the MOBILIST programme relative to other initiatives that are seeking to mobilise capital into these countries. We'll be joined later, I think, in the session by Ross Ferguson, who's really the mastermind and the leader of the MOBILIST programme in the UK government's Foreign, Commonwealth and Development Office. But in his place, he asked me to say a couple of words of introduction to the programme and the UK's interest in this topic. But before doing that, he also specifically asked me to thank the Impact Investment Institute and Jamie for chairing this session, and to thank our panellists and all of you for joining us for what we hope will be an interesting conversation. So I think it's fair to say that private capital mobilisation is a really important topic for the UK government and for its partners, particularly as we head towards the fourth conference on financing for development in Seville in the next couple of months. This topic of private capital mobilisation is front and centre. While most private capital mobilization initiatives, as I said, are in the private markets, MOBILIST aims to use public sector investment to mobilize private co-investment through listed instruments. So MOBILIST is primarily an investment program. There's research, there's policy, there's technical assistance, but really this is the UK putting its capital to work in the public markets. MOBILIST invests in listed equities and in companies and platforms that facilitate the listing of other instruments and give allocators exposure to assets in developing countries that they otherwise wouldn't have had. And it's not just the scale of public markets that has attracted the UK government into this space, it's also their transparency and their liquidity. Both of those mean that we have better price discovery, there's more information made available through disclosure, and there are armies of analysts poring over each of these investments, each of these assets on a daily basis. And that transparency is a really important opportunity when it comes to private capital mobilization. It means that investments can be scaled, successful investments can be scaled and can be replicated without follow-on impact capital and development finance in those subsequent transactions. So I think this is a really important route to fill the funding gap that is facing emerging market and developing economies, both from a sustainable development perspective and from a climate perspective. And as James said, we really hope that today's conversation will first of all be just that. We're very much looking forward to your comments and questions through the Q&A function, but also will trigger some new thoughts, some new partnerships, and some new opportunities to really scale the mobilization of private capital through the public markets. We think that collaboration between the development finance community, the donors, and market participants is so important if we're going to reach scale and trigger replication. Okay, so with a bit of background on the MOBILIST program, I'm going to spend just 5 or 10 minutes introducing the research that Jamie referred to. Not only is this a bit of a sneak preview, but even the very first slide is a bit of a spoiler as to why we think public markets are so important for emerging market and developing economies. And that's really this focus on additionality. We think this is one of the key challenges that asset managers and development finance actors face when they seek to mobilize capital through the public markets. Just to see, this issue of additionality is really central, we think, to making the case for public market impact investing. And we'll come on to this in a moment, but we do think that developing countries and emerging markets are different. There are opportunities, undiscovered opportunities for additionality in these economies. Okay, so I'll briefly touch on definition, just to see this issue of additionality is really central, we think, to making the case for public market impact investing. I'll briefly touch on definitions, but as I say, we really don't want to get stuck in that minefield. I know there are entire bodies of literature on the topics of defining impact investing and ESG investing, so I'm going to very briefly skim across them. We'll then talk about the motivation for this research. Why are we concerned with public markets? Why are we thinking about impact and additionality in these contexts? We'll touch on a few routes to impact that we think are feasible and are slightly different in the context of emerging market and developing economies, and then we'll draw out some recommendations from the paper. Just to flag, this is a policy paper, really drawing on a series of case studies of some of the excellent work that some of our panelists have done and some others have done in the market. So think of this as recommendations from practitioners that we're channeling in addition to our own reflections. Okay, so let's hope the slides move on. As I say, we don't spend a lot of time on definitions, but I think it is important to sort of just set the foundations for the rest of the conversation. So on the left-hand side here, we have what's hopefully quite a familiar definition of impact investing, focusing on measurable and beneficial social and environmental impact alongside financial returns. But what we think is most important and most interesting is this question of additionality. So that is investors that require causal evidence of the relationship between their intervention and the additional effects, the additional benefits that come with impact investing. And that's sort of an OECD terminology or a definition, but again is increasingly used by regulators in guidance and by practitioners in the market. What we quite like about the OECD definition is how they break down additionality in these 3 component parts. First of all, financial additionality. So that means that capital is made available that otherwise would not have been forthcoming in the transaction. Secondly, development additionality. So there's intentionality that there's some contribution to economic and social development through the investment that would not have been possible without the investor's participation. And then finally, value additionality. So these are the non-financial impacts that can be created alongside an investment that contribute to development. And we talk a lot about engagement and stewardship, and those are concepts, if you like, that would fall under the broader header of value additionality. So the OECD says that we can rightfully claim additionality as investors if we are either financially additional or creating value additionality and having a development impact. So it's important this isn't just about the finance, although of course that's centrally important. So that's what we're talking about today, is impact investing and additionality. What we're not talking about, what we're not focusing on, is this broader concept of ESG aligned investing. And just taking one definition among the probably hundreds that are out there, is on the left-hand side in the bottom box here, which describes single materiality ESG investing as investors that only think about ESG risks and opportunities to the extent that they affect financial performance. Over the last several years, that approach has been broadened to a double materiality concept, which considers impact, but not in the same way that impact investors require that causal evidence of additionality. So there's consideration of impact, but it's not a priority in the same way that it becomes for impact investors. And that has a material impact all the way through the investment process, and in terms of how risks are assessed, how portfolios are built, how risk assessments are undertaken, and some of these negative screens that Jamie alluded to, which we think could screen out some developing country assets that lack the data or scoring poorly on backward-looking metrics. Okay, so hopefully that sort of sets the foundation. We're focusing today on impact investing and the additionality of impact investors, less so on ESG alignment. And that's really important because when we look at how ESG investors and impact investors operate in the emerging market and developing economies, there's a really stark difference. So on the left-hand side here is the good news for the impact investors, which is they seem to be relatively well diversified across emerging market and developing economy regions. And this is pulling together data from the GIIN, the GIN, and PwC surveys from a couple of years ago. So the impact community appears to be relatively well covered in these markets. But if we look on the right-hand side here, it's clear that the overwhelming majority of that impact capital is in the private markets. So the gap here, the missing piece of the puzzle, is the impact allocations in the public markets. And we'll come on to why we think that's the case in just a moment. We can see this is the inverse to the ESG community. They are poorly allocated, relatively speaking, into the developing country regions, but they are heavily allocated in the public markets. And that's in part because of this risk screen that we touched on just a moment ago. Okay, so we think there's a gap. We think that more capital is needed in the emerging market and developing economy public markets. So next the question is why are these markets missing out and why does it matter? We think an important part of the challenge here for mainstream investors is that these markets tend to be smaller, less liquid, subject to policy and regulatory barriers, and less well covered by those intermediaries that investors rely on. But this, on the flip side, is precisely why we think impact investors should be prioritizing EMDE public markets. The limited scale and low liquidity create opportunities to prove financial additionality, even in the secondary market. The presence of earlier stage issuers means there's opportunities for greater capacity building to enhance corporate performance and sustainability standards. The information asymmetries that are a deterrent for some are the opportunity in the business model for others. And we'll hear from some of those pioneering asset managers today who have really capitalized on this opportunity to capture some of these returns and diversification benefits. But most systemically, and the point I think we really want to try and get across in this research, is there are opportunities for systemic impact by building these fledgling capital markets as impact investors. And that really we think is a fundamental public good. that can have a long-term and scalable impact. So whether that's by investing to correct information asymmetries, or providing engagement with policymakers and regulators, bringing new assets to market that otherwise wouldn't have been available to other allocators. That market building impact we think is essentially important, and something that I know that Maria will touch on in the panel discussion. And then finally, probably the most obvious answer of all is the opportunity to have a significant impact from a sustainable development and climate perspective, from an additionality perspective, because these are the markets in which 85% of the world's population live, and those communities and households are disproportionately from lower income settings. So that creates itself a development impact opportunity. Okay, I'm going to be very brief in touching on some of the routes to impact that we've just been through. So in the paper, we set these out based on, as I say, a series of case studies. We think there are opportunities for clear financial additionality at the point of listing. In many ways, that's the same argument as investing in the private markets. It's very clear to show whether and how your capital is contributing to or displacing the investment of others. We think there are opportunities to build secondary market liquidity, for example, by investing in market makers, or thinking about index inclusion, supporting issuers to reach index inclusion to attract additional liquidity. We think there are opportunities to mitigate information asymmetries by investing in pioneering issuers and instruments that create demonstration effects. And then when it comes to value additionality, we had a bit of a debate internally because we have both equity and debt people on the team, and both were adamant that their chosen strategies and instruments were the best in terms of value additionality. So equity investors have an opportunity for long-term engagement. They can provide technical assistance to their investees. They can vote in ways that encourage and incentivize effective corporate governance and sustainability management. On the debt side, of course, there's an increasing market for labeled and sustainability linked instruments, but also opportunities to incentivize more effective sustainability management, impact management, by repeatedly investing in the most promising issuers, the debt of the most promising issuers. Finally, we think there are opportunities to engage directly with policymakers and regulators to improve the liquidity, improve the market functioning, and reduce some of the challenges that other investors face. So being sort of the trailblazers in the impact community that improve the wider market environment and that can attract other investors on the way. I'm going to skip over, if it's okay, actually, the two case studies I would touch on so that we have plenty of time for the other panelists to share their reflections. And we can come back to those case studies in the conversation if it's helpful. I think the key point from the case studies is there's no single strategy or structure through which public market investors can have impact. The MOBILIST program itself is invested in listed equities, in listed funds, in the equity tranches of listed securitizations, in unlisted companies that are themselves guaranteeing listed instruments. There's a whole range of entry points for impact investors in this community. I think that's the key point we want to get through with the case studies. So the final slide here, just to touch on some of the recommendations. I think the approach that we would encourage is that investors concerned with impact and thinking about the public markets in developing countries try and integrate additionality considerations all the way through their investment process. So think about, for example, maximizing financial additionality by sizing participation in IPOs or in the secondary markets to crowding commercial capital. So MOBILIST sets a ceiling for its participation in any transaction, and then is happy to accept a lower allocation as the book builds to ensure that it's not crowding out commercial capital. And we think those sorts of approaches to sizing participation can be particularly catalytic. On development additionality, as I said, we think there's this systemic opportunity to maximize impact by trying to build fledgling capital markets. And of course, the EMD universe is a very broad one that includes China and India, as well as some much less sophisticated capital markets. So focusing on that frontier end of the spectrum, I think there are opportunities to build liquidity, to accept longer term investment horizons that others might consider. So to provide that sort of long-term patient capital that reflects the current levels of low liquidity, to target innovative issuers that bring new information to market, as well as new assets, and to engage with regulators and policymakers on a range of issues that other allocators would like to see resolved. And then finally, as I say, engaging with investees and issuers on corporate behavior, trying to think through impact-linked incentive structures that we'll hear about during the panel discussion, and then finally providing targeted technical assistance alongside investments in these markets. Okay, I'll pause there. As I say, very keen to hear some of the real-world examples from the panelists and to hear your questions and your comments as we get into the conversation.
Thanks, Chris. I'm sure I'm not the only person who has a lot of comments and questions, but the one question I will pose is, when will the research be published?
An excellent question. So it should be published in just the next few days. So we'll share a link with the participants when the research is ready for review online. And we're very happy to discuss it with anyone who has questions as they pour through the paper.
Okay, thanks, Chris. I'm also eager to hear from the practitioners. So let me introduce the panel. And if you wouldn't mind, just a wave as I call your name so that people can put a name to a face. So Martin Lemoine is the unit head for agribusiness at Asian Development Bank. Matthew Hodkinson is a founding partner and portfolio manager at Confluence Investors, an impact fund manager focusing on non-BRIC emerging markets. Maria Smith is Chief Impact Officer at British International Investment, the UK's 77-year-old development finance institution. And Louis Bourgeois is Senior Impact Manager at BlueOrchard, an impact asset manager focused on emerging and frontier markets. Martin, I'd like to start with you, if I could. Give us a bit of background on ADB, but then let's hear more about your work in agribusiness and routes to impact in the public markets.
Thank you, Jamie and Chris. Good afternoon, good evening, everyone, or good morning. I'm from the Asian Development Bank. ADB is a multilateral development bank, and we support both governments. That's about 90% of our balance sheet, but also directly the private sector. And I'm part of this group. And within that group, I'm in charge of the agribusiness sector, which is anything from seeds to supermarkets, the entire food and agriculture value chain. So within that, I have a team of around 20 bankers, and we focus on both debt and equity. And within that, it could be private or public market. And I think just to reiterate what was Chris flagged in the introduction, the great majority of what we do, I would say more than 95%, are private transactions, private debt and private equity. It's really an exception to look at public transactions, but again, it is growing. It's something we've done more and more recently, both IPOs, so equity transactions, as well as bond issuance on the debt side. So I'll be happy to give an example if you want that was mentioned in the report, if it's okay, or
yes,
you
please.
want to.
No, please go ahead. So
the example that was mentioned in the report, and it's a very interesting case in Indonesia. So as was mentioned, this space, impact investment, is really a space for outsized impact. And in Indonesia, I think we looked at a food company, so providing food to a country that has almost 300 million people. So you can see the scale of the potential impact because this country is still getting richer with a growing middle class. So when you talk about food, there is a huge space for food company providing safe and quality food to have exponential growth if they do well. So that's the kind of impact we're talking about. Also in terms of jobs and impact on stakeholders, the company, when we look at it, already at 2,000 employees. Today they are 4 times bigger than that, they sourced from 10,000 dairy farmers, and they also distributed their product. So this is a dairy company. They distributed their yogurt product through independent sales agents, women called Miss CIMORY, and there were already 3,000 of them when we did the investment, and the goal was to triple that. So this is more about the developmental impact, not so much the additionality, but I think we all agree that it starts with that. It starts by making a selection on a company that has in itself a great impact and a potential to grow that impact even more through the transaction. So, and this was precisely the case with that IPO. But one thing I want to say is that we are not really transactional. For us, the relationship with those companies is over a few years. So in this case as well, we knew the company before. In fact, the company was introduced to us by a private equity fund that had invested in the company a few years before, a fund called Creator. And we at ADB had invested in this fund. When they exited from the company, they introduced the company to us for potential debt or equity transaction. We actually first signed a loan with the company at the beginning of the COVID pandemic, to provide liquidity support just in case to the company. It turned out that the company never drew on the loan because they did so well. Against all odds, they wanted the loan to be safe, but somehow they did better during COVID. And so, great, I guess. I mean, I guess I'm not sure we had an additionality, but at least the loan was here as a safety net. But after that, because they did so well, they started to talk about equity transactions. There was a window for potential pre-IPO private equity, which would have been very attractive, but somehow we missed that window. But we still believe that there was a chance to continue the relationship and to add more value through the IPO. And this is when we decided to, okay, let's join the IPO. And here I must say that at first sight, we all believe that it's a bit harder to prove additionality in a public transaction. First, you're only one investor out of so many. Second, you're the price taker. You don't really set the terms. You basically have to go with what is being proposed. Then your information is restricted as well. You cannot access information that is not provided to all investors. You have to go with the same information, which is what is in the prospectus. So all these are huge limitations for what we do traditionally. So this is the challenge. At the same time, I think in this case, we found that there was still strong additionality. Two types. One was more financial in the sense that as an anchor investor, we had a signaling effect. The book builder was able to tell other investors there is a prominent MDBs that is going to invest. So they couldn't name us in this process because we were not named in the prospectus. In this case, it was not possible in Indonesia. In some other markets like Hong Kong or Thailand, ADB was able to be named in some IPO prospectus. That's the best, because then you can show that you've added some value and you're named in the IPO prospectus. That's ideal scenario. In this case, we were not, but we were still being mentioned, and I think we were still useful into gathering interest, especially from international investors. And the second type of additionality is a non-financial, which is called developmental or value. And this one for us was very much focused on ENS standards, and as well as gender action plan. So we work with the company to refine their environmental and social management plan, as well as their gender action plan. And they committed to a few things that they did in the years after the IPO. So I think the report will elaborate on this, but it shows that after the IPO, the company really strongly improved their ENS disclosure to the market. So this work that we did with the company was not just privately done, it was ultimately disclosed and added to the value of the company in terms of ENS disclosure. There is another element that is also a type of developmental additionality. We did a technical assistance to train the farmers. So not directly for the company, but for stakeholders in the value chain, for the dairy farmer. And that technical assistance was was very, very useful for the farmers because they faced an episode of a foot and mouth disease. It was actually not planned initially, but it turned out that the trainers were completely refocused their training to focus on the disease management that the farmer had faced. So again, as impact investor, we have multiple tools. So we have opportunity to be just beyond just a plain vanilla simple investor. We can give technical assistance. We can later on potentially provide debt financing to the company. So we have this ability to use these multiple tools, and again, not on a single point in time, but over multiple years as well. So this is the way also to look at it.
Martin, thank you. That's very, very helpful. I mean, it's particularly helpful to hear the story of CIMORY because it's helpful to visualize a specific instance and to see where your additionality comes from. And you talked about the signaling effect. I mean, you were relatively small on the IPO. The IPO was 255 million. You were 4 million. But the signaling effect is quite significant. And then the non-financial and technical assistance stuff is really quite meaningful. But it really only comes to life when you describe the specific instance. So that's great. Thank you very much. Matthew, let's talk about, tell us a little bit about Confluence Investors. Where are you active? What geographies? What investment themes? I have to say, I'm interested in your tagline, small markets, big impact. So you're going to have to explain that. And then how do you work impact into investment strategy and process? So just give us a little bit of flavor for Confluence.
Sure, thank you very much. So Matthew Hodgkinson, I'm a portfolio manager at Confluence, and our focus is on the public markets in the non-BRIC emerging markets. So that's really the more frontier and emerging markets. And our approach has a double gate. So we look primarily at equities, primarily at companies where we're seeking sort of commercial strength, but also approaching things with, we would say with a conscience. So on the commercial side, we're looking, very deep on the fundamentals. We're looking for fast-growing businesses with a long growth runway, high return on invested capital, and very interesting businesses there. But the impact side is just as important to us, and there, we're looking very much for businesses that have strong governance, and we have an impact on money analysis approach, which means that we seek to quantify in financial equivalent terms the value, the net footprint of each business we might invest on the environment and society. And across those geographies, we're looking really in sort of mainly four big themes: so climate, financial inclusion, inclusive education, and quality healthcare. If we talk a little bit about the fund, we're looking very much at those equities, but we balance that by using the sovereign credit, the sovereign debt of the same markets as a better than cash treasury function, because we are equally commercially driven. And what we're trying to do here is show that you can absolutely have impact while also delivering market compelling returns in these markets. So our fund sets out to be low correlation to global markets, and to deliver strong returns. And so far, we launched at the beginning of 2023. We've done 9 quarters of positive returns. We've managed to be positive every single quarter, and our net IRR is higher than 16%. So we're kind of 1,000 basis points above any of our benchmarks, and pretty much in line with the S&P 500. So we're doing okay. And although we are a new manager, so started at the beginning of 2023. My background, I was a partner at Satya Capital, which is the family office of a prominent African family, where impact was extremely important, really, in terms of the approach. And there we partnered with TPG Growth as their geographical partners, and we were there at the inception of the Rise Fund, who also use a methodology to quantify in financial terms the net impact of the business that they try and invest in. And I think we like these markets, we're attracted to these markets because we see there's a great deal of opportunity for commercial return alpha, but also impact alpha. We feel that here there's such a deficit of capital, particularly in the public markets, that we can deliver those returns whilst also delivering impact without there being necessarily a sacrifice between the two.
Small markets, big impact. So you invest in really small markets, Egypt, Jordan, Ethiopia, Kenya. How are small listed markets different from big listed markets? I mean, Chris talked a little bit about liquidity, lack of information, et cetera. Could you elaborate on that? Because, I mean, there aren't many people that invest in the Egypt, Jordan, Ethiopia, Kenya, and similar markets. But tell me a little bit about the small, the essence of small.
Yeah, so I mean, it's obviously all about relative sizing here. So when you're on the ground, some of these things don't feel that small. But in a global context, the African stock markets represent less than 2% of global stock markets. So, the challenge is the opportunity. So there is a great deal of informational asymmetry. There is a great deal of having to roll your sleeves up and enter data yourself. There's a great deal of not relying on Bloomberg having provided you with an Excel sheet that has all of the data in. If you want the last 10 years of data from the annual reports, you probably have to have your analyst type in the last 10 years of data from the annual reports. There is also an additional challenge of operational friction. So, broadly speaking, it's just a bit trickier and harder to trade in and out of these markets, and some of them liquidity can have specific dynamics around it. All of that works very well for us because we have devised the fund to have, to sit somewhere between a public equity fund as traditionally designed and a private equity fund. So we have slower liquidity for our investors. You have maximum quarterly with a redemption over 4 quarters. Which means that we are able to take advantage of illiquidity in terms of building up. And it also means that we are able to access and look at these fantastic businesses that fall out of the screen of pretty much all global public market investors. Because most public market investors will have a daily trading requirement or some sort of liquidity requirement. And that means there's a huge universe that there are very, very few investors able to address. And then when you sort of consider also the opportunity to engage with those companies with a positive, supportive impact approach, then you can start to sort of see how you start to have a real double win.
Great. And then, so you're saying the challenge is the opportunity, right? So the fact that these are difficult, the fact that you've kind of honed the approach means that you're able to access stuff that other people aren't able to, and that's where the impact emerges. But tell me about when you on the secondary markets. I mean, how does it help to the extent that you invest in secondary markets, small secondary markets? How does your investment help the market building aspect, the capital building aspect of that ecosystem?
Yeah, it's a great question. So I think we approach this as public market investors. How can we be gold standard in terms of delivering impact, right? So that's how we are seeking it. So the first thing we do is this. Okay, we want to make sure that the businesses that we might invest in are impactful. So for us, we use this impact of money analysis framework. So we sit down and we do this extra piece of work on every business that might be in our potential investment universe and say, is this business net impactful? And to give you sort of a simplified real world example, we might look at an education business. In Egypt, we might say, well, what portion of this education business is servicing the sort of lower income people and providing them with a higher quality education, which they would otherwise not access. We would then look across to social science research and say, well, what are the positive outcomes on healthcare, on society, on gender balance, which come from that being in place? And then perhaps the most controversial step is we will then try and put a financial value on it so that we can put it into our numbers. Of course, no business with the best will in the world is all positive. You have to build the school, you have to use concrete, you have to use power to run it. There's just this stuff. So you have to look the negatives in the face as well, and you have to add those up. And that business must then be a net positive for us to consider. So that's kind of just stage one. Now, stage two, in terms of what your question, James, is really we see that we have additional positive impact in two ways. The first of these is engagement with those companies and with the management team and with other stakeholders. So in doing that process, that impact on money analysis, we have probably identified something that we can help with, or something that the business could be doing less of. We call it mitigate, or like we would like them to do more of. So we take, again, a real world example. Sira Education is a business that does low cost education in Egypt. And in doing this analysis on the business, we identified that they had a school within a school, a refugee-focused school within the school at 2 of their sites. Now, we loved this in our analysis, and we loved it on the commercial side, because this school within a school charges fees which are a third of normal fee levels, and normal fee levels are only about $650. So we're talking like $250 a year, and it is still incrementally EBITDA positive. So as investors, we like it as well. And it does that because it uses existing infrastructure, existing teaching ecosystem. It's a win-win. So there, our engagement is about, well, first of all, you should be talking more about this. Secondly, what's the plan to roll this out? Thirdly, actually, we go to lots of places and talk to lots of people who might be interested to fund just this, separate to everything else, and let us be the bridge who helps you with that. So that is the sort of thing that we do on a sort of individual level. Now, there's a role that we think we have to play in building the ecosystem. And that's doing things like this. It's talking about impact investing. It's going to Confluence and doing that. But actually, there's a sort of key role to play in terms of helping people discover these small markets, helping these global investors discover these small markets. Now, there's a data thing that needs to be fixed. But there's also just a pure understanding thing and a human heart thing. So for that, we have something that we call impact stories. And every quarter, we release a video from a company that is on our investment universe. We may or may not have invested in it. And that is a grassroots telling of the story from the users about how these companies impact their lives in a positive way, while also pointing out that they're a highly interesting, credible commercial company that, maybe you could just think about. So it's sort of here and here.
Thank you. I think you've answered my question, small markets, big impact. Thank you very much for that. Maria, BII. So you've been at the forefront of recent thinking on market building as a route to impact at scale in some of these less developed markets. So how do you at BII, how do you contribute to building capital markets, and what's been your experience in public and private markets so far? I mean, so far meaning over the last 77 years.
77 years. I've been here 12 years, not quite 77. So I can maybe talk closest to that decade. But yeah, so for those that don't know, BII is the UK Development Finance Institution. So we have about £8 billion of assets across Africa and South Asia, mostly in the private sector, but very similar to ADB. We have been increasing some of the work that we've been doing in public markets. So I'll touch on that. But maybe just to set context about how BII assesses impact, which is very similar to the way Chris described his framework, but slightly nuanced. Every transaction that we make is assessed through, first, our impact scoring framework, which is our portfolio tool that allows us to compare impact performance across our different sectors and products and geographies. And the second is what we call our contribution framework, which is a look at additionality as well, so financial value as well as mobilization. So how that our impact score considers market creation and capital market development is in a few ways. I mean, the first way is that the score itself, you select a primary impact pathway or a primary need, and that can be capital market development. That's one of the needs that we identify. And that's actually differentiated by the need in the country. So obviously the less developed capital markets get prioritized within our framework. On the market creation side, we've identified sort of 5 pathways that market players can operate. And one is around competition. The second is around replication, so considering first mover disadvantages. The third is around demonstration, so investments that sort of prove that the risk in the market is lower than what is perceived. And we see a lot of this in Africa. The fourth is around developing skills and capacity. And then finally, improving and enabling environment. So this could be through regulations or other interventions. And so that's sort of how our score recognizes market creation or incentivizes, let's say, market creation and capital market development. In addition to that, we put all of our transactions through this contribution framework, and they are very similarly as laid out to Chris. We think about financial additionality. There we ask the questions, is capital offered at all? Is it offered on the same terms? Is it offered in a significant amount of quantity? We also consider active mobilization. So, we look at both simultaneous mobilization, but also actually sequential, so we can be forward-looking, and we assess how much and what multiples we're considering, and then value additionality, very much anchored to areas where we at BII add value around climate, around gender, and around overall corporate governance. So if that sets the context of how we think about these things. As I mentioned, most of our investments have been private investments, but increasingly we're doing more in public. So, quite a few instances where we have invested in companies and helped them with IPO readiness, and seen them through IPOs and stayed in, either because for regulatory reasons we needed to, or we just wanted to see them through that stage of the business. We've done quite a bit on sustainability bonds, where we have helped in markets like Tanzania, Egypt, Nepal, where we've been part of the first sort of the design and the execution of first sustainability bonds. But I thought an example that would be easier to give is one that was probably more trickier one on the additionality case, because I think, when you're talking about helping a company build for an IPO or even issuing a first green bond and building the framework, the additionality story is a bit clearer. But a good example of where we've had, I'd say, more robust conversations internally is Helios bond or Helios Towers. So this is an investment where BI provided a $30 million anchor commitment along other DFI investors. And this was a public bond listing in the LSE, which helped refinance its existing debt, but also, helped improve communication services across multiple countries in Africa. So, there's a secondary component here. You have a very large issuance. And here, what we thought about with financial additionality is that, we were anchoring money. So in this instance, I think it was around 150 million of DFI capital that mobilized over 700 million of private investment. And we also considered this from a markets perspective to be a demonstration effect, because we were crowding in institutional capital. And it helped because when this bond was issued, there was certainly negative investor sentiment in Africa. So you're seeing capital, because of all of the challenges we've had geopolitically, and with rates where they were, we were seeing certainly outflows on the continent. And so, that played a factor into our decision making as well. So I thought that it was probably a better example because it wasn't as straightforward of an internal assessment. But we do see the importance in DFIs, building confidence, and addressing some of the negative optics in all of our markets, actually, but particularly Africa.
Let me ask you, Maria, does BII have a return requirement for its balance sheet? And if so, does that limit the role it can play in the catalytic function?
Yeah, so we have a total portfolio target that which is low single digits. But it's very much, so it's backwards looking and it's a rolling return as well. But we have different pools of risk capital that we use. So we have what we call our growth pool, which is where we would mainly target to keep our returns comfortably above that hurdle. But we also have a catalyst pool of capital and what we call a kinetic pool of capital. And those have higher risk appetites and lower return thresholds, where the kinetic pool is actually quite concessional, and we use it increasingly for blended finance. So we would have we would expect that we would be loss making in a percentage of the portfolio. So these different pools of capital allow us to use them in different situations. And blended finance is increasingly a big part of our strategy. And especially as we look to mobilize more in South Asia, where we have a big climate focus on mobilization, blended finance is quite clearly going to be an important tool for that. And so I would expect that you would see us sort of increasing what we're doing, the financial instruments that we're innovating for in that space. But of course, that means to hit our target return, we are going to kind of have to continue to do more investments that are providing the financial return.
A very interesting description of how you effectively barbell in the sense that you create the capacity to do concessionary / catalytic investment by making sure you have an appropriate allocation to growth investment. And then that allows you to then deliver the balance sheet return that you need. Because I think a lot of times people with portfolios with a target return have a hurdle rate for investments rather than something different. And so if it's below a certain number, then they won't invest in it. And they don't think in the terms that you do, which is let's allocate a bit of our portfolio that will make up for whatever shortfalls might occur on the catalytic or concessionary side. I mean, it's an interesting approach. I wish more people were comfortable doing that. I mean, there are lots of people in lots of different environments who are doing that, but I think it's a really interesting, your description is really interesting. Thank you for that. Louis, let's go to you. So give us a bit of background on BlueOrchard, and then talk to us about impact in fixed income. Because historically, a lot of people have really focused on impact in the equity space, and I would love to hear more about the fixed income space. And then how do impact considerations affect the way you construct portfolios?
Thank you, Jamie. So at BlueOrchard, we have been working in impact investment for 25 years, mostly in private debt first, with microfinance. We have the largest microfinance fund in the world, but we have also in the past 7-8 years pushed to different asset classes with listed debt. We've had our impact bond fund for more than 7 years now, and we have more than $1 billion in asset management actually in listed debt. So very happy to have grown this with our portfolio management team and our impact management team. Maybe just about how we are structured at BlueOrchard. We are managing these strategies with 2 independent teams. The impact management team that I'm part of, I'm a senior impact management manager at BlueOrchard, which is looking at the impact of each and every investment that we are looking at and building the investable universe for our portfolio management team. And then this team is making sure that we are providing attractive returns for our investors. We have different tools to make sure that both from a sustainability risk perspective, but especially from an impact perspective and an additionality perspective, we provide also the impact returns that we are aiming for. So we have an impact scorecard where we are going to extract impact indicators in order to gauge the impact of each investment, but also then provide reporting for our investors. From an additionality perspective, I found the paper and what Chris said really interesting, and sort of maybe touching upon all of these points. I think the most tangible for us in listed debt market is the engagement. I think engaging in terms of contribution from an investor perspective, engaging with issuers is part of what we do. We engage for disclosure, for additional disclosure on the impact side, on sustainability side as well, providing best-in-class reporting examples, providing feedback also on framework. We really push to have to give maybe additional feedback. We value the work that the BII and ADB of this world are doing, and really I think in emerging markets this is excellent to have these actors to come up with excellent frameworks. Often actually much better than some developed markets actually. But we also have something to say on frameworks of these labeled bonds. So you have green, social, sustainability bonds that we invest in. So here, I think engagement is really important. We also have long-term relationship with these issuers. We come back to them, and I think this is maybe different than on the equity space. We have the possibility with these multiple issuance maybe every year to always have a roadshow to participate in, to have maybe a private conversation with these issuers, to follow up with the impact targets, and have that constant conversation with some of our issuers, which is, I think, definitely important for us to make sure that the impact is delivered, and also to keep maybe not some pressure, but to make sure that the management is aware of how important this impact is for impact investors like us. Maybe on disclosure also, and a sort of engagement, we're also helping sort of market building. We are we are on the steering committee of the Impact Disclosure Task Force. I think this is a very interesting initiative in listed debt market, especially in emerging markets. So we have, of course, the GSS bonds, the green social sustainability bonds that are excellent as impact investors, but there is also a whole subset of the market that is not able maybe to create these type of or doesn't have the scale of their assets to create these type of bonds, but have an impact story to tell. And with this, actually, this Impact Disclosure Task Force is quite interesting also. So yeah, I think this is also part of the things as asset managers that we can be involved in, and push for greater disclosure, and push to create markets actually that don't yet exist. Maybe last point on the financial additionality. We also try sometimes to participate in issuances that are smaller, but are sort of that have that demonstrator effect. One example is the women livelihood bonds. We were there in 2020 and their second issuance, that was 12 million, I think, to really show other market participants, show our investors that this was important. This was also really innovative, and we're here also to support this with smaller amounts than other actors on that panel. But I think this is we still have a role to play in providing feedback and also capital in this type of bonds. On the women livelihoods bonds, maybe briefly, they are supporting financial inclusion, SME lending, agriculture, sustainable agriculture, also especially with a gender lens. And yeah, I think that's different points on the additionality on my side.
Great, thank you, Louis. I'm gonna move to some group questions, and I want to remind the audience to go ahead at any time and drop questions into the Q&A. I don't see any at the moment, but if you do have any, this would be a good time to drop them in. And I'm going to ask the group about how development finance, MDBs, and asset managers can work together with each other. So MDBs and DFIs, MDBs and asset managers. I mean, instead of, I'd love to know how the ecosystem, the collaboration ecosystem works. And in that context, Louis, I wanted to ask you if you can answer a question that's sort of curious about, which is, what has been the effect of you joining up with Schroders? Since I think of you as you've now become effectively the center of gravity for impact investing at Schroders, and it's an interesting dynamic. Do you have a comment on that? Maybe you don't have a view, in which case I'll withdraw the question, but it's just interesting. It's not just that there's Schroders and then there's BlueOrchard. There's BlueOrchard, which has kind of infiltrated Schroders and created an awareness of impact investing within a conventional asset manager that wasn't there before. Or do I have that wrong?
No, I think this is a good question. So since 2019, we are part of Schroders. I'd say from an impact management perspective, we've had Maria Teresa Zappia, that is our deputy CEO at BlueOrchard, but also sits in and has different hats, head of impact at Schroders, to name one of them, and that has really brought from a Schroders effect perspective, really brought our impact management framework, our way of thinking about impact, our impact tools, of course, brought this to Schroders and then galvanized different asset classes that we were not also involved in. And then now I think there is 15 to 20 different products that are following that impact management framework. They've also, because of their size, been able to also probably improve also these tools, and that has been a good partnership for me personally. I have access to a lot more data and resources to be an impact manager. So it's been, I think, definitely positive. Not talking about the sort of distribution and sales perspective.
Well, I think that's an interesting description, because I think between what you've just described and what Maria was describing before, I mean, there is a role for asset managers to work the ecosystem and not just find investments that create impact and do the reporting on them, but have a more systemic influence. And it feels like that's what BII is trying to do, and that's what you guys are trying to do within Schroders. And I have to say that I can see the effect from Schroders because I have various interactions with them. And so it's interesting to see how you can create a multiplier and influencing a demonstration effect that goes beyond the individual investments that you're making. So I want to open up, I want to extend this question and ask all of you, because we've got an MDB, a DFI, and a couple of asset managers. So let me ask you, how could these communities how do these communities work with each other, and how could they work better with each other? And let's take the public side versus the private side. What does the public side wish that asset managers would do, and what do asset managers wish the DFIs and MDBs would do more of? Yeah.
Maybe I can check from ADB's perspective.
Yes, please.
How can we work together? I mean, very clearly now we have an objective to mobilize private capital. We've changed our targets from this year. $1 of ADB and $1 mobilized is equivalent in terms of what we have to achieve. So there is no more incentive to maximize our own balance sheet, deployment of our own balance sheet, because what we can mobilize from impact investors has the same value when it comes to what we have to deliver. And we have to deliver 13 billion per year by 2030. So there is a very large target. So we will need to work with more banks and impact investors. So on the private transaction, we do it quite a bit already. We have a syndication team that will mobilize funds such as ILX. It's an impact asset manager specialized into joining development finance transactions. So that's one example. On the equity side, all the impact funds that are doing private equity would regularly co-invest with us into private equity transactions. So on private transactions, this working together between development finance and impact investor is already happening at some level. But I think I'm very interested in this discussion now, because I feel that there is an opportunity for public transactions to work together, because what I've heard in this discussion is that we have a very complementary role. MDBs or DFI really work more inside at ground level with the company to look at action plans, farmers, gender, to visit the factory to make sure the environmental and social is compliant. So we really do. We are quite specialized into going deep into the company and doing all this work, but we are not that good, I think, at making it very public or making it available to the rest of the market. And hearing about Confluence and BlueOrchard, I think you guys are excellent at stripping this information out of the company to make it more widely available to all shareholders and all bondholders. Louis, you mentioned engagement, perpetual engagement. So I don't think MDB or DFIs are very good at that. So I think there is almost a role to team up together almost from the start and make that a combined additionality. What we will do up front in terms of groundwork and to make the company better, and what the impact investor will do in terms of making sure the market discipline remains over the years after that. I think that's very complementary, and that's something I think I've discovered on this call. So I think that there is Jamie, you're right. There is a great potential to work on that ecosystem.
Maria, what would you add to that? I mean, do you have a one-to-one matching requirement at BII?
We don't today, but mobilization is increasingly one of our core objectives, and we're in the middle of revising our new 5-year strategy, and it no doubt will feature sort of as one of the key KPIs. But I think it's also just the world we're operating in right now, the ecosystem. I think there's going to be a bigger focus on mobilization in a capital constraint environment. Partnerships are going to be key. At the World Bank Spring Meetings the other week, there was just nothing but talk about moving from coordination to collaboration and really deepening these efforts. So I think it's clear we need to work together. In my opinion, the focus needs to really be on addressing like risk tolerances. So I guess if like to your question on what would I ask, I think the more we understand on what the blockages are, from the private sector, from commercial investors, is it, what is the need? Do you need diversification? Do you need investment grade risk? Do you need certain financial hurdles? Like, is it optics? Is it governance? What are the blockages? And then, we can be quite innovative in terms of how we structure instruments, or we focus our interventions on technical assistance, et cetera, to meet that. But I think all of us getting a bit sharper with our pencils in terms of like what exactly are those risk blockages, so that we can help address them.
So are you meeting with the likes of Confluence and BlueOrchard to have these conversations? I mean, is this conversation actually happening?
It is. It should be happening more though, right? For sure. So, these types of sessions are always good for catalyzing these investments. But yeah, we'll make sure they are.
Okay, asset managers, do you want to defend yourselves?
It was pretty positive so far, but happy to talk about it. From BlueOrchard perspective, we have a whole blended finance team. So they're at BlueOrchard, and we've been doing this for years. So we are used to these conversations with DFIs, with MDBs to try to create products, but more on the private debt, private equity side. Still because the subject here is listed markets, there's definitely a lot of different ways to collaborate already. Just as I was stating before, to create the best type of instruments, of bonds. This is really useful in emerging and frontier market to see the work that, and I can feel if I just look at the prospectus of a framework already when there is the touch of an MDB or a DFI or not, and this allows us to sort of go into bonds from our at least impact management perspective really freely, because we know that there's going to be great reporting, great impact measurement. So I think this is interesting. Different things that maybe would be good to create maybe strategies with DFIs, with MDBs. One thing would be, and I think Chris at the very beginning was talking about not crowding out private sector. So often you have MDBs, DFIs that create excellent bonds, but sort of keep it for themselves in a way, and so this way you don't really have a market. It's not there, and so that might be also interesting to see what is put in the paper in this, to allow us to have access to these excellent bonds from an impact perspective. I think this is a really interesting one. Also, maybe as an anchor, or in a strategy, having the possibility to say at the start, these instruments are not liquid. We are trying to help the issuers, and in case we need liquidity for a fund, a DFI, an MDB is pledging a certain amount of liquidity to buy back some of these bonds. That could be also maybe some different ideas. The last part is also just again on liquidity, having this capital liquidity tranche, for example, that is staying put, and in case you have some events where private investors are exiting the funds, we know that we have these partners that are staying in there, and helping also, I think, private investors to be more or to minimize the risk also from a liquidity perspective. One last thing I'll say is just really understanding the private investors, because that's always, if we want to scale sustainably these strategies, I feel like sometimes there is there's a little bit of a disconnect, and we want too much on both sides. And so trying to really understand what the private investor wants. We want something that is really comparable, because they are comparing us to even these ESG strategies that we are talking about for a big chunk of capital. So we need to be competitive, and so we need to also allow us some additional degrees of freedom.
Yeah. Matthew, what would you add?
So, James, maybe I could be a little more challenging.
Go ahead, be my guest.
So from the Confluence perspective, Confluence investors, I think we would think about three things that we would look for from the DFIs. So the first is mentality shift, the second is around supporting public market fund investments, and the third is in data. So on the first, obviously this is perhaps a little bit unfair with BII and ADB here, who are perhaps in the vanguard or the forefront of considering
Indeed.
Public markets. You're even here. But broadly speaking, from a DFI perspective, there's historically been this feeling that you mature the company and then you drop it off at the public markets, where it's got a deep pool of liquidity that's going to solve all of its financing needs, and it's got wonderful requirements for disclosure that's going to make sure that impact and ESG is considered for the future. And now we're out of here. And I think that there needs to be a recognition that the public markets and a lot of our markets do not work like that. And not only do they not work like that, but the trend since 2016 has been in the opposite direction from liquidity and from oversight. And if we don't change it, then that's how it will continue to be. So, that mentality shift around, oh, it's public markets, that's not us. It would be great if we could move the dialogue on that. Number two is incredibly self-interested. But we would love somebody out there to consider investments in the public market impact funds. So maybe because there are so few of us, or maybe because of the first problem, we very much fall between the cracks about, yes, I think we can do this, but we don't have a team who analyzes a fund like yours. Well, don't do it because there aren't any other funds like ours, or there are a few. So, there's incredibly self-interested, but, we would love to, see that.
Doesn't BII invest in funds?
We do invest in funds, but I think the point is public market funds.
Public market.
Yeah, and
Okay.
I think the challenge, look, I mean, just to respond quickly to it, we've had a few funds that a portion of what they do is public. We don't have any that their entirety do. We should talk offline. I think the challenge is making sure that our policy requirements are able to be filtered down. But we've done some work on this, so a lot this year. So we should talk offline.
I think we made a point. Yeah, we'll.
Matthew, real quick, because I want to move to some. Chris has now selected several audience questions that he wants to profile. So go ahead.
Then I'll whistle through number three. So number three is around data and ESG data. So Chris had a great slide on there where he showed how much ESG investing was in public markets. But if you dive into that and you dive into how much is in our markets, it's actually basically in Africa it's zero, in Southeast Asia outside of China it's essentially zero, and there's a challenge there which is about data, and that is an area where DFIs and fund managers and asset managers in the ecosystem could work together, and it's not quite impact investing, but it certainly will help us all when we're looking to get exits, when we're looking to get IPOs, when we're getting to get more liquidity into these markets.
Before we go to your questions, Chris, I would love to register an interest in having more effort put into reaching out across these various stakeholder groups. So is there a way, forget the individual issues, but is there a way to get asset managers, DFIs, and MDBs talking more frequently and more interactively on product initiative strategy and that kind of thing? That's really what I look for. And maybe this webinar is a piece of that, but that would be my wish for this group. But I want to go, Chris, to your first question.
Jamie, could I actually, before we get to the questions, just give you one example of context in which MOBILIST was involved, but also ADB and others that I think speaks to that, which is the infrastructure financing gap in Asia. And several years ago, ADB, I think, and AIIB through intermediaries came together to try and find a structured solution to this infrastructure financing gap. And working with other partners, they put together and provided seed capital for Bayfront Infrastructure Management, so a standalone platform that has been building an infrastructure ABS concept that really didn't exist in the emerging markets before Bayfront came along. So they had those two MDBs in at the beginning. MOBILIST came into the fourth transaction in the series, taking a piece of the equity tranche in the transaction. You then had Grantco, which is a pitch company providing guarantee to the MES layer, and you had AIIB taking some of the senior notes that came out at the end of the transaction. So it's a really nice story, I think, of MDBs, DFIs, and in this case, a donor program working together to build an entirely new market of infrastructure ABS. And there have been two more transactions in the last couple of years since that fourth transaction that MOBILIST participated in. So building a bit of a cluster of comparables. Anyway, on to the questions from the audience. So I think there's an excellent question here from Alan Whittle. Given the importance of additionality to impact, what are the panel's thoughts on the, quote, dumbing down of the need for additionality, particularly in the public markets from the GIN and the FCA? So should we really stick to the additionality requirements, or should we think about it as a journey?
Up for grabs, anybody?
Well, shall I respond, James?
Yeah, go ahead.
I don't think I have the whole piece here, but I mean, our view at Confluence is broadly, we kind of run our own race. So we set out to say, what do we think is the right thing to do as impact investors? And yes, we voluntarily comply with SFDR Article 9 and all of the requirements around that. But actually, if we sit down and say, these are the things that we think make us impact investors, that is to do with the fact that we use this financial analysis to evaluate, is every business impactful? We engage with the companies to try and help them be more impactful. We promote the impact ecosystem, and we tie a portion of our performance fees to how we do on the delivery of the impact goals. All of those things are what help us to sit down to our investors and look at each other and say, yes, I think we are an impact fund and we're doing that. The overlap with what we have to do to be an SFDR Article 9 fund is zero. So,
Well, yeah, I mean, that's Article 9, right?
But actually, the GIN and FCA definitions, I think our approach is the same. I think you have to decide, but what I will say is that impact is very much in the early stages, and so there are many routes to success here, and I'm reluctant to close too many of them down or say that is wrong or you should be doing this. So I think at this stage we're happy saying this is what we do and we're happy with it.
Interesting. Any other comments? Otherwise, Chris could go to the next question. Go ahead, Chris.
Because there's quite a specific question from Danila Boneva about appetite for investing in post-conflict countries. But I think if we take that as a broader question about potential trade-offs between the development and the scale of a market and the reach into some of the hardest markets to serve, how do we think about that trade-off in liquidity, performance, some of the regulatory considerations and so forth?
I'm assuming the DFIs and MDBs would be the most adventurous in terms of investing in post-conflict countries. So maybe Maria or Martin has a view on that.
Yeah, no, I'm happy to I'm happy to start. So I mean, we as obviously like as a DFI, you know, we do want to go into the most challenging places. And so if we operate in sort of 64 countries, again, if you think about our impact score, it prioritizes us putting capital into into the countries with less access to capital and in the bigger needs. How we do that, though, you know, we have to triangulate with our, you know, financial returns, our liquidity, our resources, our, you know, our local presence, et cetera. And so how we think about it overall is, you know, there's certain like we would typically go more through intermediaries, whether that's funds and partners that are local on the ground or through financial like banks, you know, so we do a lot of risk sharing with banks to lend to SMEs into markets like Sierra Leone and Ethiopia. And then, or we've been providing funding through banks in Ethiopia now that they've opened up. And so, you know, we have to use, I think, different products to offset sort of the risk in these markets. The other thing that I would say is what we're working through at the moment is how do we apply our policies and responsible investing in these markets where it's much harder. So particularly when it comes to things like ESG, you know, we will take I think, contextual and proportionate approach to markets. So for example, you know, if we have an environmental and social action plan with our investees before we invest, so that over the period of our investments, they have an action plan to meet the gaps that we would expect on our policy and responsible investing. We will look to have a more proportionate length of time that action plan can be filled, and it will certainly be taking into account the contextual situation in those markets and what's possible. And you know, that's an iterative process for us. We continue to sort of tweak and refine that. But I think it's important, right, to recognize the specific challenges in each of these regions.
And Martin, does a multilateral development bank have more or less flexibility to invest in post-conflict countries than a DFI, say? I mean, certainly more than commercial, but then compared to a DFI, do you have more or less flexibility to invest in problematic post-conflict environments?
I think from a risk appetite, the traditional approach to it, we will be extremely conservative. So in a sense, like public transaction will be very rare in this context because there is no established financial market, or it's not liquid, as Maria mentioned. But even private equity transaction will be difficult because, again, of the question of the exit. So even equity transaction will be structured like a debt-like transaction where we would want to have the company's cash flow to repay the investment. So we will really look at the repayment from the company, not we wouldn't hope to be selling the stake to someone else. So this is the difference. It will be very structured and more private. At the same time, we also have a pocket of donor funds for those countries, including from ADB's own shareholders. They have set aside some funds that can be used to de-risk transaction in those markets. So similar to what Maria mentioned with this pocket of fund that is more adventurous or has a lower risk, as a higher risk appetite, lower return threshold. We can use these funds much more in those markets. So yes, so I guess you know, we're even looking at considering transaction in, let's say, Afghanistan or you know, like places where not Myanmar, you know, but I think post-conflict area would include. I mean, in our category, we classify countries like Papua New Guinea or Lao PDR as being like conflict affected, and so we have ability to deploy funds and blended finance in those markets.
Great. I know there are more questions out there, Chris, but it is coming on to 3:30, so I unfortunately need to close the seminar, sadly. And you'll be glad to know I'm not going to try to summarize the breadth of insights you've heard over this last hour and a half, from both the MOBILIST research and from the perspectives of these practitioners who are active in these markets. So they've given you a lot to think about, and I hope they will prompt you to think differently about your own relationship and posture vis-a-vis the emerging and frontier markets. And then you'll get another chance to give the analytical wheel another turn when you then read the MOBILIST research, which will be published in a couple of days. So I'd really like to thank MOBILIST and the Impact Investing Institute for sponsoring this webinar, but in particular MOBILIST for managing the logistics and the preparation and a lot of the heavy lifting. MOBILIST, I'd like to thank MOBILIST again for its creative program for supporting capital flows to EMDE markets, and in particular for sponsoring the type of research you heard about and that you will appreciate reading. I'd like to thank our speakers, Chris, Martin, Matthew, Maria, and Louis. And then thanks to you, the audience, for accepting our invitation to think differently and thoughtfully and on a more forward-looking basis about listed investments in emerging and frontier markets than you might have done in the past. So thanks, everybody, and goodbye.